This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Adam Besvinick, founder and managing partner of Looking Glass Capital. Looking Glass Capital is a pre-seed and seed fund that seeks to invest in and support mission-driven founders during the earliest days of company building. Adam, thank you for joining us.
Hi, Hall. Thanks for having me.
Great. So where are you calling from today?
I'm calling in from Westchester County, New York, so just about 40 minutes north of New York City.
Great. So tell us more about your background before joining Looking Glass Capital.
Yeah, so I've been in venture now full-time for nearly a decade at this point. I spent the first handful of years at a couple other funds, one called Deep Fork, where I was doing pre-seed and seed investing for about 3 years, then another fund called Anchorage Capital Group, which is about $19 billion hedge fund where I was doing Series A through Series C investing. And I started Looking Glass in 2020. So Fund 1 I raised through most of COVID, started investing out of it in September of 2020, and recently started investing out of and raising the balance of Fund 2 for Looking Glass.
Great. So what excites you right now?
Right now, the thing that I'm most excited about is the number of high quality entrepreneurs that are still building companies despite what the market looks like. I think the bar for starting a business has certainly never been higher in the 3 years since I've started this firm, and probably never been higher in the 9 to 10 years that I've been in venture full time. And so I think the quality of entrepreneur that I've met with and seen over the last 12 months has been extraordinarily high. And that sort of ratio of signal to noise in terms of quality to quantity is at an all-time high. So to me, that's at a high level what's most exciting to me. I'd say more specifically, regardless of what the sort of the founder profile or background is, things that I'm most excited about are really a return to and focus on investing in companies that are not just nice to haves, but are must haves. And so that really aligns with the themes that I've been investing in since starting this firm around healthcare, climate, education, even a number of tools and platforms for small businesses that are essential to how companies operate and essential to how patients' livelihoods or patients' well-beings. And, climate's not sort of a nice to have, it's a must solve issue. And so the things that are exciting to me are the categories that continue to attract capital, kind of regardless of what the broader economic climate looks like these days.
Great. Well, you see a lot of startups and a lot of investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
If it's an angel investor, I would say pretend like this money doesn't exist anymore and it's not coming back. I think the failure rate of startups is so extraordinarily high. I think the collective sort of early stage venture ecosystem got very, very jaded over the last several years, if not longer, that there was always someone ready to write the next check to that company, kind of almost regardless of how well that company was doing. And so that's one thing that I think has changed over the last year is there's a lot more clarity around whether this company or a company deserves to raise additional capital. And so if you're just getting started investing in early stage venture as an angel, you need to understand that there's a tremendous amount of risk associated with that. And then also recognize that professional investors that are managing funds have portfolios for a reason. And so if you're going to be an active angel or whether you're going to start a firm, et cetera, you have to commit to having a large enough portfolio, enough at bats, because if you make, 3-4 investments, there's a good chance that none of those are going to work. But if you're seeing a high quality number of companies and you make 25, 30 investments, then now all of a sudden you're giving yourself much better odds of those companies performing, because you could probably take 3 or 4 companies out of, my career track record and see 3 or 4 zeros for sure. But this is a business that's really focused on outliers. And so you need to make sure you have enough at bats to hit some of those.
Great. And then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
It's one thing that I've been pleasantly surprised by over the last year is I've increasingly seen more and more founders pressure testing their ideas before going out and raising capital. I think during the throes of 2021, you saw a lot of fly-by-night founders who were raising money and then quitting their job, right? Like, I'm looking for a VC to fund my salary to convince me to start this company, as opposed to, I've decided to start this company. I've evaluated, the markets. I've evaluated how to build a product in this space. Maybe I built a prototype up for it already. And now I'm going to go out and raise capital. That didn't really exist all that frequently, 18 to 24 months ago. Now, particularly over the last 12 plus months, you've seen a lot more founders that are actually self-funding their companies for a little while. They're bootstrapping them to make sure that this is something that they actually want to dedicate the next 6, 8, 10 years of their life building. And so if I look at the companies that I've invested in over the last 7 months out of Fund 2, all 3 of them had a product that was live and in market in some capacity already. A couple of them were generating revenue, not millions of dollars of revenue, but meaningful revenue that was clearly an indication that someone of note was willing to pay for this product. And these were companies that had been around for 4, 5, 6, 7 months. These weren't founders that woke up one day and said, hey, I'm going to go and raise venture funding to start this company. They actually had sort of, sanity checked their ideas and tested whether they made sense. And to me, that's one of the pleasant sort of benefits of this, tougher fundraising environment, is that founders are spending more time evaluating whether this is something they want to devote the next, half decade to a decade building. And early stage VCs are the beneficiaries of sort of that momentum that founders might have even before they go and raise capital.
Great. Well, let's talk about the state of startup investing. How do you see the industry evolving from here? Where are we going?
Yeah, I kind of alluded to a little bit of this, but I think we've seen a return to what, early stage investing looked like when I started investing, almost a decade ago, which is a $2 million round or $3 million round was a relatively high bar for founders to clear. And yes, there's certainly plenty of companies that can go out and raise that much money with very little or frankly, even more. But I think we're seeing a lot more rigor applied to evaluating companies at that stage. I think the pace of investing and the length of fund sort of deployment periods is lengthening significantly. And that's a function of 2 main things. One is more diligence being done by VCs, and the other is VCs extending their deployment periods and doing fewer deals per year. And so now you've got, more diligence and slower investment pace, which those 2 things compound, and you have extremely long fundraising processes ahead for founders, even for a first round of capital that they might be raising, when those processes would, in some instances, lasted literally days, in the peak of 2021. So I think all of this is a healthy, reset and refresh for the broader ecosystem, and one that I wouldn't say VCs have significantly more leverage than founders did. I would just say it's been a rebalancing where investors can now actually credibly take time and do work. And in my mind, it's a benefit for founders because now they really actually get to know their investors and get to understand who they're sort of getting in bed with, so to speak, for the next decade, as opposed to the midst of sort of the hype cycles of 2021, where you had investors getting onto cap tables and the founder had hardly spent any time with them at all. And now all of a sudden you don't really know who you've signed up to work with for the next 6, 8, 10 years.
Well, that's great. So let's talk about your investment thesis. What exactly is it and how did you come to it?
So I'm investing in a way that I feel like is differentiated from a lot of other pre-seed funds, which is I want to take a much more institutional approach to pre-seed investing. And for me, that means being much more disciplined around check size and ownership and valuation and portfolio construction. And then that really comes from the institutional experience that I picked up during my time at Anchorage, where I was the sort of weird, exotic, VC investor surrounded by a bunch of public markets and credit investors who were ruthless with portfolio construction and portfolio management and pruning positions and adding to positions and, things you could do with a liquid market. But I got to witness what it meant to be, a truly institutional oriented investor, as opposed to a lot of other, a lot of early stage pre-seed VCs who I would say don't necessarily apply the same level of rigor and diligence to their own processes. And so that's sort of the fundamental sort of strategy that I'm bringing to market. The next piece is that I'm taking a very thematic and sector oriented approach to what I spend time on. So I invest in healthcare, climate, education, and tools and platforms, specifically serving small and medium-sized businesses. And within healthcare, it's largely software and tech-enabled services, either healthcare infrastructure or vertical specialty care for patients. I don't do devices, I don't do life sciences, I don't do biotech or pharma. And then similarly within climate, again, it's all software and software-driven solutions. I'm not investing in things that might look like frontier tech or deep tech and are eons away from commercialization and look more like science projects than near-term revenue-generating businesses. And so really focused on backing, the software opportunities within these spaces that I'm spending time on. And I don't make exceptions for these categories. I don't deviate from these themes. As an individual investor, a single GP, I have no other employees. I'm, working with the portfolio, I'm deploying capital, I'm fundraising. I don't have time, frankly, to be chasing deals in all sorts of other categories. And so I pick these themes, one, because I think I can build a firm for the next 20 years investing in these categories and never have to change them. I think these are categories that are timeless in that way. Certainly the sort of subcategories might ebb and flow, but healthcare, climate, education, small business, these are sectors that will always matter from a capital sort of attraction perspective, as long as I'm building this firm. And these are areas that I've been investing in for the last decade. I was investing in companies that you would call climate tech now in 2015 that I didn't think of as climate tech at all. I just thought that they were really smart founders building a cool product, solving a large problem, like a company called One Concern, which is in the resilience space and sort of mitigating, climate disaster space. But I didn't think of it as climate tech in 2015. I just thought of it as a really awesome product in a huge market. Just happened to be something that fell into climate, right? It was just a software investment at that point. It didn't really feel like a climate tech type deal. And then the other element of these themes, beyond being sort of timeless, is I think they were relatively economically resilient. As I mentioned earlier in our conversation, healthcare, climate, education, these are areas that are must-haves. These are not, take the analogy, these are painkillers, not vitamins, in terms of solving problems in these spaces. And I think they attract a founder that is naturally more resilient than maybe founders in other categories. And if you're building in healthcare or climate or education, these are fairly fraught sectors. They're regulatorily challenging oftentimes. And it really usually requires having very relevant operating experience in the space to know how to navigate a lot of the existing incumbents and convince them to engage with you. And so I think they self-select for a founder that really knows, these spaces inside and out, and gives them an unfair advantage compared to maybe an outsider who's trying to build in these categories.
We used the term resilience several times. Would you call this the age of resilience? It used to be the age of growth, but interest rates are not going to let that happen anymore. But what do you think about resilience being the watchword?
I couldn't agree more with that. I mean, I think it's resilience in the face of attracting capital, right? Like, healthcare companies and climate companies and others are still growing despite the fact that other categories are not. And then entrepreneurs themselves need to be resilient, right? There's a lot of talk that a flat round is an up round and a down round is a flat round in 2023, right? And an up round is exceedingly rare. And so being able to, I think Fred Wilson wrote in his year, prediction for the year, surviving is thriving this year. And so figuring out ways to extend runway, figuring out ways to pull rounds together that don't look like traditional sort of priced rounds with a regular lead and, follow-on investors, all of the scrappiness that is required to build a company, I think is, that much more valuable at this point. And so, I mean, I see it with myself fundraising for a fund too, right? Like I need to naturally be resilient and figure out all sorts of ways to make sure that the fund is properly capitalized to execute the strategy that I want. So yeah, I think resilience might definitely be the word of 2023 and maybe 2024.
Yeah. It could be a while before we get back to the growth again, but it's just part of the cycles, I guess. But what are the challenges you see your startups facing most these days?
I think the biggest challenge that almost every company faces these days is figuring out ways to grow while also being capital efficient. Right? You have sort of founders are being pulled in two different directions right now. They're being told like, cut costs, keep your burn rate down. Oh, but by the way, like keep growing though. Like, right. Like to your point before, it was like growth at all costs. Who cares about profitability? Grow as fast as you possibly can. There's always going to be another check behind mine to fund you. Now it's like still grow very quickly. Maybe not growth at all costs, but still grow very quickly while also cutting all of your costs. And I've heard multiple founders in the portfolio sort of like bemoan this over the last few weeks. And it is a really difficult tension. I think there is sort of a very nice sort of coincidence, at least for a number of companies that I've been talking to recently, where their current monthly burn is actually at a level that they could hit from a revenue perspective and figure out how to get to cash flow positive in the not too distant future. And that revenue number is actually a very good milestone for being able to raise a Series A, right? 150, 200K, maybe a little bit more in monthly revenue is a pretty good figure still in my mind for justifying a Series A round, despite what the broader sort of like venture market looks like. And it just so happens that a lot of companies that are approaching that level of revenue are also at that type of burn rate. And so you have this sort of happy coincidence where my burn rate might be the revenue number, and hopefully I can get to a default alive state, take sort of my destiny into my own control, and then have the choice of raising a Series A or not, depending on how much more quickly I want to grow. And so I would, on that point, I think, at least to your original question, to me, that's the number one challenge that I think most companies are facing right now, is that tension. But I definitely think it's worth sacrificing, grow 3% month over month instead of 6% month over month, if it's going to allow you to keep your burn rate, at the same level, if not lower, right? If you can keep demonstrating some type of progress month over month, to me, that's a clear indication that you've figured out a way to not sacrifice growth for the sake of, cutting burn. But if you just start to grow entirely linearly, then at that point, it becomes a little bit more challenging to compel an investor.
Well, great. My next question is, what online information source do you find most helpful in your work?
And I still think, despite all of Twitter's, foibles, to put it mildly, I still think Twitter remains one of the most sort of insanely useful tools for what I do on a day-to-day basis. Whether it's, sharing information about companies that I've invested in, discovering new companies. I've backed multiple companies across Fund 1 and Fund 2 that I've discovered through Twitter. Having a presence on Twitter is increasingly valuable, and for me, being accessible to founders and other investors, and putting thoughts out there, and demonstrating what I care about, and being able to build quote unquote personal brand for attracting capital and attracting deal flow. Twitter still remains insanely valuable as a brand building source and an information source. From a pure play news or sort of industry insider information site, I think Eric Newcomer's Substack is one of the few Substacks, might be the only Substack that I pay for, and I would definitely pay more for it. I think Eric has incredible sources. He puts out incredible interviews with really great investors and founders, and has delivered from day one on what he set out to do. And so I would encourage anyone listening to this to subscribe to, it's called the Newcomer Substack, and he does an awesome job with that.
Great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I think I did a great job of sort of running through the gambit of what's on my mind from a venture perspective, both across the categories I'm investing in and the broader landscape. I think maybe the only thing that I would add to the conversation is just around, sort of what I'm seeing right now resembles a lot what we saw at the beginning of COVID in terms of a bifurcation of where capital is being concentrated. And so I still see pre-seed and seed investing being a place that's attracting lots of investor attention, both pre-seed and seed focused investors and later stage investors who are willing to write a seed check because they get the same amount of ownership that they normally get with putting less capital at risk. And it feels like a call option for them. And then the Series A and Series B sort of, no man's land, even Series C to an extent, is sort of just not seeing anything or very little. And then later stage investing, where it's very clear that those companies are going to be the anointed winners, and it's just a matter of how big they get. At the beginning of COVID, it was Stripe and Figma and Canva, and all these guys continued to attract capital, even when deals were getting done over Zoom and people were apprehensive about that. And so I feel like this barbell sort of very bifurcated approach is what we're seeing now. And to me, it looks a lot like what we saw in April, May, June of 2020 before things, got nuts in the back half of 2020 through most of 2021. So that's one thing that I would call out that we didn't talk about.
Yeah, it's a different market and it's changing again, just like it did back then. So it's good to see that come back around at this point. How best for listeners to get back in touch with you?
Yeah, I'd say the number one way to get in touch with me is to send me an email. So it's adam@lookingglass.vc. That's my website. That's my fun name. I read and respond to every single email that I get, which is a blessing and a curse. But it's the easiest way to get in touch with me by far.
Great. We'll put your contact details in the show notes. I want to thank you for joining us today, and we hope to have you back for a follow-up again soon.
Great. Thanks all. Really appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.